sounds to me like it's a business opportunity for smaller debt funds. We heard from Martin that the banking sector sees this market as relatively small, or the allocations are not as such. So there might be an opportunity even for senior debt there in these markets. We hear that you stop somewhere in the 60 to 65% loan to value, which means again there's an opportunity for the mezzanine player. We heard from Josh that nearly 3/4 of the investment transaction volume comes from equity, so therefore I would imagine that all equity investors, they would be happy to get some of their equity out in due time out of refinancing. So what is your feedback on that? It sounds like a very good business opportunity, and a question primarily to Martin, to what extent you're cooperating with alternative debt providers, and to what extent you have heard relevant moves in terms of alternative lenders coming to the market and you are the comparator in certain ways you compete with. Thank you.
Okay. Let's start with the senior lenders. In the past, you certainly had more senior lenders like Eurohypo, Westimo being active in the market. They are now more or less replaced by other banks coming back or entering the market on a new basis, like Deutsche Hypo, which opened up an office in Warsaw, or Erste Bank is now coming back into Poland here. So the senior market is still, I would say, competitive, and there's certainly enough money available. When it comes to the senior funds, you heard a lot about senior funds being set up. You heard a lot about money being raised, but we do not see them as competition. Sometimes when you speak about senior funds like Allianz or some other ones here, you probably team up with them. But in Central Europe, Allianz would like to be, as one of the major players, would like to become more active, but I haven't seen them on any transaction yet. But capital also from these funds is available from the bigger funds. When it comes to mezz funds, you hear a lot about the mezz funds or the junior providers. And there's certainly also a lot of capital around, but if you ask me, as the LTVs are moving up, when they set up the funds, they were expecting that they probably have to provide between LT5, 55 and 65 here, and now they realize, okay, oops, I mean, this sector or this range is already, let's say, occupied by the senior lenders again here, so they have to go up the risk curve as well. And then the question is, are clients willing really to pay these higher margins? And if you ask me at the moment, the answer is some, yes, but not many. Because I think the investors' quality has changed as well in the past. If you look at Heitman here or see very global investors, in the past they were also happy getting 65, 70, 75% LTV. But their investors in the meantime have also changed their mind, saying, if we do it 50% LTV, that's also okay for us. And we also have some other funds, really reducing their outstanding LTVs, which is not over-leveraged, but they're reducing it from 50 to 40, even to 30%. Here. And I think this is the trend, and this is clearly what just showed in his chart, that the investors' strategy, the investors' thinking in such kind of leverage has clearly changed. And that's why I think it will be, for most of the mezz funds, it will be difficult to allocate their money.